Hello and welcome to another edition of Trust Issues from Kepler Trust Intelligence. Today I'm joined by Ayush Abhijeet, an investment director at WhiteOak Capital Partners, which is the investment advisor to Ashoka India Equity, which has the ticker AIE. AIE is a sector-leading Indian equity investment trust that was launched in 2018, during which time it's delivered a net asset value total return of 156.5%, and a share price total return of 139%. Its sector peers have trailed quite a bit, delivering an average NAV total return of 44% and a share price total return of 56% in that time. AIE looks to capture the best growth opportunities at reasonable valuations from India, with a bias towards small and mid-cap companies. Impressively, the managers have outperformed their benchmark in every year since launch bar one, as a result of their stock selection-driven process. Ayush is responsible for covering the technology, consumer discretionary and metals sectors at WhiteOak. He joined the company in 2017 and has more than 10 years of experience in investment management, equity and macro research. Ayush, thanks for joining us today.
Thank you, David. It's a pleasure to be on your podcast.
Now, we'll start off with a kind of a dive into the Indian stock market at the moment, because we've seen that after a very strong run upwards, indexes have kind of been trending down recently and have kind of settled maybe 15% below their highs. What would you put the sell-off down to?
You're right. The Indian markets had a couple of very good years, 2023, 2024, and even prior to that, calendar year 2020 and 21 were very strong years for the equity markets. And over the last 5 months, we have seen a meaningful pullback in the Indian equity markets. The headline index is down by about 18 odd percent in dollar terms. Now, in the absence of a cataclysmic event like the pandemic or an event like the global financial crisis, it's very hard to pinpoint the real reason for such corrections. Such corrections are par for the course and even healthy because it allows the markets to build fresh legs for the next set of rally to happen. Now, having said that, there are multiple narratives around what could have led to this market correction, and I'll talk about 3-4 of them. Right, the first one is that the GDP growth in India has turned out to be a bit weaker than what one would have expected 12 months ago. Right, so the broader economy has seen a bit of a slowdown. Consumption has been a bit muted. And partly it's also got to do with government spending, which has taken a breather. So government capex did slow down over the last 7 to 8 months, primarily because of the central elections. Because in India, typically in and around the central elections, a lot of the decision making at the state government level, at the central government level, and some bit of business decision making also comes to pretty much a standstill. So a lot of these reasons have contributed to the economy seeing a bit of a mid-cycle slowdown. So GDP growth rate was expected to be, let's say, 6.7%. It's come down to now 6.2%. Right? That's the kind of relative slowdown that we're expecting in the Indian economy. The second reason, and partly ties back to the moderation in GDP growth, is the earnings growth at the index level. So fiscal 25, which is 12 months ending March of 2025, have turned out to be a fairly muted period for corporate earnings growth in India. In fact, it would be the slowest earnings growth in the last 5-6 years, right, since the pandemic. At the start of the year, we would have thought that the index earnings growth would be somewhere around 8 to 10%. And even on those moderate expectations, the earnings growth is now looking more like 4%. So that's been a bit of a disappointment. And for context, India's earnings growth for the last 5-6 years has been trending at high teens. And the longer term earnings growth trajectory for India, if you look at the last, let's say, 30 years, that's been about 12 to 12.5%, right? So that's a long-term trend line. Last 5-6 years, we have seen above trend line earnings growth, and this year has been way below trend line. The third reason around this correction is this entire sort of new uncertainty because of Trump 2.0. right? Trump remains a wild card, not just for markets in India, but everywhere in the world. While we do think that India is likely to be less impacted compared to many other countries, but again, it remains a wild card, and markets do not like uncertainty. And the fourth reason has been around flows. So since September of 2024, we saw flows moving into US and China from India. China had a very large consumption stimulus announced by the regime there, amounting to about $1 trillion, which is 6 to 7% of the GDP. And it was one of the biggest stimulus announcements that we saw in China, and that started the first wave of capital flows into China from many other markets, including India. And then in the last 2 3 months, after China's DeepSeek moment, which has brought everyone's focus towards China's AI capabilities after the runaway AI rally in the US. China's AI capabilities were mostly ignored by the market, and DeepSeek brought that capability at the forefront, and that's the second leg of rally in China. So both of these events has led to some money going into China from many other emerging markets, and parallelly, the US market also has sucked away flows from every other market, including India. So these would be, David, some of the reasons that are being attributed to the current correction.
And kind of just picking up on that kind of last point about flows, one long-term tailwind that we have seen for Indian markets is from domestic investors investing through their pension accounts, which has kind of added up to around $3 billion a month. Has this held up well during the sell-off?
Yeah, it's a very interesting point. And just to set the context for this discussion, if you look at the ownership of the Indian markets, right? So who owns the Indian stock market? Uh, there are you can break it into four components, right? The first is the founding families or the controlling shareholders own about half of the market. So half of the stock market, 49.5% to be precise, is owned by the controlling shareholders, the founding families. Then the next two big owners of the stock markets are foreign institutional investors and domestic institutional investors in India. Both of them now own just about 17 to 18% each. And the rest of the market is directly owned by retail investors, high net worth individuals, etc. The domestic ownership of stock markets has been structurally increasing over the last decade, right? As the foreign ownership has been coming down. So foreign ownership uh, and domestic ownership today are almost equal. A big driver of domestic flows has been the financialization of savings in the country. Historically in India, a lot of the household wealth has been tied into assets like real estate and gold. And equities have not found adequate representation in most household portfolios when you compare that to most other markets globally. And there's still a long runway to go in terms of equities finding their adequate allocation in household portfolios. Now, as a result of this financialization, what we're seeing is that more and more families, more people are coming into equity markets, allocating greater part of their savings, either directly or through their pension assets, into the equity markets. And therefore, domestic flows have been very strong over the last several years. Just to put the numbers into context, in the years 22 and 23, we saw $20 to $25 billion each. And last year, we saw $50 billion worth of flows from domestic investors, of which currently the run rate is about 3 billion per month. Now, the experience around these SIPs, as they are called, systematic investment plans, has been that they tend to be fairly resilient to market downturns. Case in point was the sharp correction during the COVID pandemic. So in 2020, March 2020, the markets corrected sharply. During that time, we did not see, there was a minor blip, but we did not see the systematic flows into the market fall off a cliff. Even now, up until January, we have seen these flows at around $3 billion per month. Right? We'll see how the February data looks like. We should see some bit of contraction, but for the most part, these have tended to be fairly resilient to market downturns. At the same time, I must caution that many of these smaller investors have come into the market post the pandemic in the last 5, 6 years and have not seen a severe, sustained market correction. So while the pandemic was a very sharp correction, you also had a V-shaped recovery. So these investors haven't seen a structurally weak bear market, prolonged bear market that grinds down for several quarters at end. So the behavior could turn out to be different if the market were to trend down, let's say for another 3 to 6 to 9 months from here on.
So you kind of mentioned, stock market corrections after a strong run, are healthy, if anything, maybe. Do you kind of see this as more of a potential kind of opportunity to buy than something that's longer lasting?
The caveat here would be that it is impossible to predict the direction of markets in the short to medium term, right? Nobody knows, nobody has a clue. In the very long term, we can still have a reasonable assumption. Our assumption is that, as has been the case over the last 30 years, that the Indian stock market has delivered returns pretty much in line with earnings growth of the market, which has been in line with the nominal GDP growth of the market, of the economy. So even going forward, let's say when you think about the next 10 years, I would think that if the earnings growth of the market or the GDP growth of the market is going to be, call it 10 to 11% in nominal terms, similarly 10 to 11% earnings growth, and we expect the headline index to deliver 10 to 11% annualized over the next decade in local currency terms. You take out 3 to 4% for currency depreciation. So we are looking at 6 to 7% annualized dollar returns for the market over a long period of time, right? That should be our base case. That should be the starting point. The more attractive aspect of the Indian market, and the one that is often less appreciated, is the inefficiency, the alpha opportunity, right? So far what I've described is the beta opportunity. That's the beta of the market. What we think is a more exciting aspect is that the Indian markets are still very inefficient. They are probably the most inefficient large market anywhere in the world, right? Today, the size of the market is about $4.5 trillion, which, just to put things in context, is the fourth largest stock market in the world. After US, China, Japan, India is the fourth largest stock market. So it's a fairly deep market, but the most inefficient, which allows active managers like us to extract a very good alpha from the market. So the alpha opportunity can be as big as the beta opportunity of the market if done well over long periods of time. So I would leave it at that. It's impossible to predict the direction of markets. It could very well turn out to be a good buying opportunity. When we look back 2, 3, 4, 5 years out, as of today, very hard to say. But valuations at the index level have now come below 10-year average, right? If that is to be any guide, it does look, at least relative to its own history, a bit more attractive than what it was probably 6 months back.
And we mentioned in the intro that AIE has a bias towards small and mid-cap names, but it also has the ability to invest in pre-IPO capital. Now, we've seen a lot of IPO activity around, particularly with some multinationals that are looking to list their Indian arms on the stock market. How fertile of an area is this for AIE?
So extending the argument around inefficiency, just like India is a more inefficient market compared to other developed markets and many other emerging markets, within India, the mid cap segment, the small and mid caps tend to be a lot more inefficient compared to the large caps in India. And therefore, they've always been fertile hunting grounds for us to extract outsized alpha from the market. And the team has done a great job at picking stocks within mid and small caps that have delivered outsized alpha. Another unique aspect of the Indian market is that it's very fragmented. It's very heterogeneous. And you can compare and contrast India with, let's say, a market like Taiwan or South Korea, where one or two industries dominate the market. So if you go to Taiwan, 60-70% of the market is just semiconductors and electronics. Same would be true for Korea. Maybe 50% is electronics and allied industries. But when it comes to India, it's a very heterogeneous, very fragmented market. No single industry dominates the economy. And at the same time, if you look at the breadth of companies, India has several thousand listed companies, of which a few thousand are actively traded. And for us at AIE, our investment universe is probably the top 1,000 companies. So our investment universe is 1,000 businesses in India. And of course, this investable opportunity segment itself has expanded quite meaningfully. When we launched the trust back in 2018, 17, 18, during that time frame versus today, this investable set itself is round about doubled for us. And partly it's a function of new companies listing, and partly it is just the economy and the business is kind of increasing in size and becoming investable. Over the last few years, IPOs, primary listings, have been very healthy. In fact, last year was one of the biggest years for new listings. You did talk about some MNCs listing in India. Those would be a smaller proportion. They do get headlines, but a smaller proportion. But largely, these were domestic businesses, Indian companies tapping the public markets. And a big differentiator for us at AIE has been our ability to tap into many of these companies in a very selective manner at the pre-IPO stage, right? So the trust has the ability to invest up to 10% of the NAV into these private companies. And our sweet spot tends to be companies that have a clear line of sight to an IPO, let's say in the next 12 months or thereabouts. And the strategy has delivered very strong returns for us and is a big differentiator for us in the India trust market and overall broadly in the single country trust market as well.
Now, we recently at KTI wrote an article about the myth of concentrated portfolios and kind of bringing that point of the expanding universe that you guys have. I wonder if we could kind of touch on that again. Now, AIE has 146 holdings in its portfolio, which is obviously a higher number of names. What does this level of diversification bring to investors?
Great question, David. And we have been talking about this precise topic that India is a market where you can actually increase your alpha opportunity by having more number of names in the portfolio, right? So the concentrated style of investing, I do not think is the right way to approach the Indian market because of the long tail of businesses that exist in India, because of the heterogeneity of the market and the long tail of businesses. Unlike many markets where the top 10, 20 stocks are a disproportionate part of the market cap, in India there is a big belly that exists, big belly and a long tail, if I may, which also means that if you restrict yourselves to, let's say, hypothetically investing in only 20 companies in the portfolio, you will miss out on a large set of alpha opportunities where you may not be able to buy, let's say, 5% of that position in the fund, but you may be able to buy only 1% of that position. So do you want to ignore such alpha opportunities? Our approach has been that we want to buy those businesses, but even at much lower positions in the fund, because we think that these are meaningful alpha opportunities. And the proof of the pudding is in the eating, as they say. If we look at the attribution for our trust, we have very clearly seen that many of these smaller positions, which tend to be in the small cap segment and the mid cap segment, have actually delivered outsized alpha for us over the last 6 odd years.
Now, before we go, could you just give us a quick summary of the measures announced in the recent budget? Is there anything worth mentioning to investors that would ease any concerns given recent revision of GDP and earnings growth figures?
Certainly. There are two notable things. Number one, what stood out in this budget was the government's continued focus towards ease of doing business in the country. Right? This has been a demand from the corporate segment, the business community, that we need to bring down the barriers to doing business. You need to bring down compliance norms, right, which are fairly burdensome in many pockets of the economy. So there was a very clear focus towards reducing the burden of compliance and improving the ease of doing business, which I think is a very positive aspect of this particular budget. There was a focus on simplification of taxes, which again is the right direction of travel for the economy. Number two, major announcement was around taxation for the middle class. So now in India, up to a certain income, about 4 to 5 times of the per capita income, there are zero income taxes. It's in a way an indirect consumption stimulus for the middle income segment of the economy. There would be additional, just about 10 to 12 billion dollars of additional savings that would accrue, which would find its way into various consumption categories. So this is a this was another positive development, and in a way, government's acknowledgement that they needed to do something to boost the weak consumption environment that has existed over the last couple of years. So it's good to see the government take cognizance. And finally, I would say that the overarching theme or the overarching element of all the budgets that we've seen of the last few years has been fiscal discipline, fiscal conservatism, and that remains. We have not seen subsidies increase. We have seen the government walking a very tight rope on ensuring that the fiscal deficit has a clear glide path to 4.5% or thereabouts. The current account seems to be in a good situation. Inflation has been trending down. The central bank has meaningful space to cut rates even more because India has positive real interest rates. The gap inflation has been trending down, and interest rates in the economy are much above inflation. So the government central bank can cut rates if and when required. So I do think that, and of course, the banking sector is in a very good shape. The real estate economy sector is in a very good shape. So all the macros, most of the fundamentals are quite intact. And I would not be surprised that the economy recovers soon from this mid-cycle slowdown that we have seen over the last 6 to 12 months.
That's really interesting. Ayush, thanks for joining us today and sharing your valuable insights into the Indian market.
My pleasure, David. Thank you for having me.
Now, if listeners would like to find more out about AIE, we have plenty of insights on the Kepler Trust Intelligence website, which you are more than free to check out. Thanks for joining us today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.